You'll have to put on your professorial hat here. Firstly, to explain to us, sort of the debate over or the discussion over potential output and why it's important to have that right now and why you're focusing on it.
I think the growth imperative never felt this urgent. And I'm talking about emerging markets more generally. Coming out of this pandemic, let's take the case of India's debt. Public debt's going to be 90% of GDP. And for that debt to be sustainable, it's really going to be all about the denominator and how growth evolves more than the actual pace of fiscal consolidation. That if we can target real GDP of 6.5–7%, so nominal GDP is 10%, then even a more gradual pace of fiscal consolidation will first stabilize debt to GDP and then over time bring it down. If, God forbid, nominal GDP were to be closer to 8%, then no matter how quickly you consolidate your fiscal, debt to GDP keeps rising. So both for job creation, ameliorating incomes and debt sustainability, potential growth and medium-term growth never felt this urgent. The other reason one has to have this discussion is a little bit, I'm going to veer towards monetary policy. One of the big puzzles has been that India has experienced this large contraction last year. Even when we recover, will be 6–7% below the pre-pandemic path. All of this should be very disinflationary. We should have seen core inflation plummet and plunge, and yet core inflation has been stuck around 5%, slightly higher than 5% now for 15–16 months. And the question is that telling us something about the supply side that we need to take into account going forward? I mean, we've seen this K-shaped recovery where large firms have grown their market share. Is that resulting in higher pricing power? Has the impact on SMEs and therefore competition on the supply side been more than we think? These are all telltale signs that looking at potential output afresh is going to be very crucial going forward.
And you're sort of, honing down the analysis of the supply side into one aspect, which is total factor productivity.
So it's a very limited aspect with all humility, because I think every element of, so if you think of, output, GDP is essentially a function of capital stock. It's a function of labor force, labor, which is population growth times labor force participation. It'll be a function of human capital and educational attainment. And then it'll be this catch-all term called total factor productivity, which is a proxy for productivity of the different factors of production, allocative efficiency in the economy. And what we're seeing is there's been a fair amount of talk on investment. We've discussed the fact that investment has now moved from balance sheets more to utilization. I'm going to be humble in saying that the impact on human capital around the world from people being out of school for 17–18 months is going to be large, sustained, and really beyond the scope of our analysis. I think, experts in that area should focus on it. We're just taking a small sliver to say everyone's focused very much on the investment slowdown over the last decade. What we've kind of neglected is the role that productivity growth plays to output. If you look at India's kind of growth in 2005–06, TFP contributed 5 percentage points to potential output back in 2005–06. And this was true of all emerging markets. That was the kind of the golden period for EM productivity growth. That in our computations has halved. Before, this is all pre-pandemic, it's come down to 2.5 percentage points. So quite apart from what higher investment will get us in terms of potential growth, we also have to look very closely on productivity growth, which is half. Now, this is over a 15-year period, so it's a long-run problem. What are the 3 factors that we think influence it? At least the empirical analysis finds that trade openness is an important correlator of TFP growth. So we want to remain open. We want to take advantage of this export boom. We want to keep imports free, because in this new world, you need imports to re-export. So trade openness is a crucial determinant. The financial sector is a crucial determinant. And this should be very intuitive, that ultimately how an economy's savings are allocated comes down to how efficient the financial system is. And the third is public investment. So none of these are non-intuitive, but we find strong empirical support that the health of the financial sector, how open an economy is, and whether we get sustained public investment have a crucial role to play for TFP and therefore eventually for potential growth.